Here's what Wall Street doesn't want you to know. Right now, in July 2026, the biggest money in the world is making moves that contradict what 99% of retail investors are doing. While you're panicking about the NASDAQ being down 4.5% this month, institutional investors are quietly positioning themselves for what comes next. We've been digging into the data, the headlines, and what the smart money is actually doing. And today we're breaking down 5 savage investment strategies that are working right now. Let's be real, the market is sending mixed signals. The S&P 500 is up just 0.6% this month. The Dow is practically flat, but here's the kicker. Bitcoin is up 7.3% this month, and gold is climbing too. Meanwhile, Fed rate hike odds are surging because of rising oil prices. Geopolitical tensions with Iran are spooking the markets, and new tariffs just took effect. This is the kind of environment where smart money makes its biggest moves. So let's jump in. Move number 1. The chip sector contrarian play. Yes, the NASDAQ is down 4.5% this month, and a huge reason is the chip sell-off that's been happening. Every retail investor and their mom is panic selling semiconductor stocks right now. But here's what Wall Street sees that you don't. This is a gift. Institutional investors, the ones managing billions, are actually buying chip sector dips. Why? Because the long-term thesis hasn't changed. AI infrastructure still needs semiconductors. Data centers are still being built. The companies making the chips that power everything from ChatGPT to autonomous vehicles aren't going anywhere. The short-term volatility is noise, and Wall Street knows that noise creates opportunity. Here's the play. Instead of panic selling, contrarian investors are dollar-cost averaging into chip ETFs like XLK or directly into companies like NVIDIA and ASML during these pullbacks. They're not timing the bottom. They're just buying consistently while everyone else is running for the exits. You can do this too with any brokerage app. Charles Schwab, Fidelity, Webull. The move is boring but brutal in its effectiveness. Buy chips on weakness, especially if you have a 5 to 10-year horizon. Move number 2. Bitcoin as a hedge against rate hike odds. Now this one is fascinating because it goes against conventional wisdom. Bitcoin is up 7.3% this month while everything else is struggling. And that's not a coincidence, it's strategy. With Fed rate hike odds surging, Wall Street's smartest investors are using Bitcoin as a volatility hedge and an inflation protection tool. Think about it. If the Fed raises rates, cash gets more attractive, but inflation expectations are baked into that scenario too. Bitcoin, which has a fixed supply of 21 million coins, becomes more attractive as a store of value. Large institutions are adding Bitcoin positions not because they're crypto bros, but because it's uncorrelated with traditional stocks and bonds. Bitcoin's at 64,590.80 right now. 6 months ago? It was lower. A year from now? It could be significantly higher, especially if geopolitical tensions escalate or inflation concerns resurface. The move here is allocation, not all in, but maybe 2 to 5% of your portfolio in Bitcoin, through a spot ETF like iShares Bitcoin Trust, or directly through Coinbase, if you're comfortable with self-custody. Wall Street's doing it at scale. You can do it at retail scale. Move number 3, strategic tariff positioning. This one requires some actual market analysis, but it's where the real money is being made right now. New tariffs just took effect, and this creates winners and losers immediately. Wall Street isn't betting on whether tariffs are good policy. They don't care. What they care about is which companies benefit and which ones get crushed. For example, companies that manufacture domestically get a competitive advantage. Their products don't face tariffs. Companies that rely on imported components get squeezed. This creates massive arbitrage opportunities. The move is sector rotation. Investors are moving capital from tariff-vulnerable sectors, like consumer electronics manufacturers that import from Asia, into sectors like defense contractors, domestic manufacturers, and companies positioned to benefit from reshoring trends. You can execute this by looking at your current holdings and asking, does this company face headwinds from tariffs or tailwinds? Use tools like Seeking Alpha or your brokerage's sector analysis to identify where the flows are going. This isn't about predicting government policy. It's about reacting to the policy that's already in place and positioning accordingly. Move number 4, the gold accumulation strategy. Gold's up 0.7% this month. which doesn't sound sexy, but watch what's happening underneath the surface. Institutional investors are accumulating gold at a faster pace than retail investors realize, and it's because gold is the ultimate chaos hedge. Here's the macro picture. Oil prices are rising because of Iran tensions. The Fed might raise rates. Geopolitical risk is elevated. When you have uncertainty plus inflation expectations plus geopolitical risk, gold becomes the risk-off asset of choice. Unlike Bitcoin, which is still seen as risky, gold is the boring, unsexy asset that billionaires quietly load up on when they're worried. Gold's at $371.90 per ounce. Wall Street's move is a measured accumulation, not betting the farm, but adding 5 to 10% to their gold exposure through either physical gold, which you can buy through apps like Gold Money or Bullion Vault, gold ETFs like GLD, or mining stocks like Barrick Gold. The play is insurance combined with opportunity. If everything continues higher, you'll feel the regret. But if things get weird, and geopolitical tensions suggest they might, you'll sleep better knowing you have exposure to the asset that holds value when everything else is questioned. Move number 5. Leveraging ChatGPT's new finance tools and the privacy arbitrage. Now this one is weird but worth paying attention to. ChatGPT just released new finance features that let users link their bank accounts directly, and financial experts are raising major privacy red flags. But here's what Wall Street sees. This is a data opportunity. As millions of people link their financial accounts to ChatGPT for real-time analysis and advice, OpenAI is sitting on an absolute goldmine of anonymized financial behavior data. Banks, fintech companies, and investment firms are going to pay serious money for insights into consumer spending, saving, and investment patterns. The move isn't about using ChatGPT's finance features yourself, it's about positioning in the companies that will benefit from this data wealth. Companies like Microsoft, which owns a stake in OpenAI, data analytics firms, and fintech platforms that can monetize financial behavior data are the real winners. You can position yourself by owning Microsoft or fintech ETFs like FinX. The broader point, always look at who owns the data and who's going to monetize it. That's often where the real money flows. Now, here's how you actually act on this. First, you don't need to do all 5 moves. Pick 1 or 2 that resonate with you and your risk tolerance. Second, use this framework. Understand the macro environment, identify where institutions are flowing capital, and follow that flow with conviction. For the chip play, set up a recurring monthly investment in a chip-heavy ETF. For Bitcoin, research custody options and decide if you want to own it directly or through an ETF. For tariff positioning, spend an hour analyzing your current portfolio against tariff risk. For gold, set a target allocation, maybe 5 to 10%, and add to it over the next few months. For the data play, just understand that AI and data companies are going to eat the world over the next decade. Here's the brutal truth. Wall Street makes money in volatile markets because they have a playbook, and that playbook is built on contrarian positioning and following the flows of capital. You now know 5 of their moves. The question is, will you act on it, or will you sit on the sidelines while institutional money eats your lunch? The market doesn't reward hesitation. It rewards conviction, planning, and being positioned before everyone else figures it out. By July 2027, Bitcoin could be at 100K, chips could be ripping higher, and tariff plays could have paid off massively. Or none of this could happen, and we're in a different market entirely. But that's the point. You have to position for scenarios, not outcomes. So here's what I want you to do. Pick 1 move from this video that makes sense for you and implement it this week, not next month. This week, comment below which move you're going to try first. And if you're serious about understanding what Wall Street is actually doing so you can position yourself ahead of the crowd, hit subscribe because we're breaking down these strategies every single week. Your future self will thank you for paying attention now. Let's get it.